To one person, all of this is pain. To me, Stephen, and all of you, the 5%, this word becomes opportunity. Sorry, had to spell that one out as I write it. You notice how I changed it up? For one person, it was pain. For another person, it was opportunity. Opportunity to buy stocks severely on sale. Opportunity to buy vehicles that you can then turtle for income severely on sale. The opportunity to build a rental portfolio, a real estate portfolio severely on sale. The opportunity exists for those of you that are prepared. What's up, everybody? It's Chris and Stephen from Wealth Webinar, and today we're going to get into this. This is part 2 of the preview for this weekend's 3-day training, which is being called the Now. So when I say that, what now is the basic main thing that we're discussing. What's going on right now, and what are you going to do next? How are you going to get ready for the recession? Midterms are over. The election results are starting to come in. We're seeing some of the impact on Wall Street today with about a 300-point sell-off. What we've got to do is get crystal clear on what you need to do to prep and prepare for the coming storm. The coming storm, if you don't know what that is, I don't mean the hurricane that's hitting Stephen's house right now. I mean the financial storm, the recession that we're already in, technically. Not only the recession we're already in, but what the impact could be this time and why. Those are the items that we're going to cover. But Stephen, I want to turn it over to you for a little bit.
All right. So put on in the chat box if you were on last night. So let's see. All right. So a few people were on last night. Okay, several. So yeah, so maybe just a quick little recap, just real fast, kind of what we went through. And then we will definitely get the recording out to everybody later today. So we'll email it out to everybody.
Yeah. So what we talked about yesterday, just to get it out of the way, is we talked about what's now. What's going on right now? Last night, we hit heavily on the midterms and the impact that politics are playing on the markets. We had a couple of weeks of a bull run. I wouldn't call it a bull run, but we had the markets going up for the last few weeks. And a lot of people were super excited about that. I had people calling me saying, oh my God, is it time to get back in the market? I said, absolutely not. That is a trap. It happens every other time, right before the whole thing goes off the cliff. But you know what? A lot of people did. They jumped in. They said, oh, it's time to buy in, buy low. That isn't buying low. That's buying stupid. That's buying FOMO. That's buying temptation. And unfortunately, that's going to bite a lot of people straight in the you know what, because temptation and FOMO will always lead you off a cliff. But that's what most financial decisions are based on. They're based on the temptation. They're based on using your emotions to invest. So few of us use logic as the single guiding light when making financial decisions. But if you just paused and you delayed the gratification that comes along with FOMO and instant gratification and the temptation of all of this, and you just looked at the facts, here's what you'd see. Although the market's been up the last couple weeks, now some of that's probably politically driven because they want to look good. Hey, it's kind of like you're going to go to the prom, right? You're going to get all dressed up. You're going to show up to the prom. The next morning, you're probably not going to look so good. Well, that was what the markets were doing. They were putting their best attire on, and the politicians and all the institutions and the banks and everything that plays into that were making it all look really good because we want it to look good for the current administration. Hey, everything's okay. Nothing to see over here. We're not in a recession, says one of them. You all know who I'm talking about. We're not going to be in a recession, but let's look at the logic. Because if you can put the temptation and the FOMO behind, you're going to be able to make decisions based on pure logic. And because of that, you're going to be able to avoid the pitfalls that come along with emotional-based decision-making. And that is exactly what you need to do. And what are some of the main things? So let me just come back here and just show you some of the main things that we really need to look at. Number one, high-level cycles. Market cycles, just like seasons, right? We're just coming out of the fall season. Before the fall season was summer. We all know the transition from summer to winter is a drastic one, especially here in Buffalo. We go from 80, 90 degrees, beautiful, into, holy shit, we got 6 feet of snow outside. We're entering the winter season. Well, the financial markets work in a lot of the same ways. There are different cycles. And just to go through some of them, these are the different cycles and the productivity and everything and how the economy works. Productivity growth is when you go to work and you work hard. The harder you work, the more productive you are, the more products that get produced, and that's normal static growth. Then you've got long-term and short-term debt cycles shown here, okay? You've got different periods. You got an inflationary period, which we're in right now. Inflation means everything is going up in cost. Not really. Inflation really means your dollar buys less, but you guys all know that, right? And if you don't, watch the rest of that YouTube video you saw in the beginning. It explains that inflation really isn't the cost of goods and services going up. Inflation is the fact that they printed a lot of extra money and your dollars got weaker, so it takes more dollars to buy the same goods and services. But I know that's too much to comprehend. Can't you just say, Chris, that the groceries got more, the diapers got more, the clothing got more, the cars got more expensive, the gas got more expensive? Right. Everything seems more expensive because your dollars suck. So there's inflationary and then deflationary period. It always comes, one follows the next. Seasons. You can never, ever not have different seasons. I don't care where you live. We go from summer to fall. Some parts of the country, fall is beautiful, right into winter. There's nothing that you can do to change those. So the same thing in the financial world. We go in inflationary periods followed by deflationary periods. Deflation is when all those assets deflate. Go outside with a really sharp steak knife and just puncture your tire. You'll understand what deflation looks like, and it will cost you some money because now you got to replace that tire. Think of that as your assets. Go to any of your assets, your 401k, your house, your investment properties, that boat you bought, anything, and poke a hole in it and watch it deflate. That is deflationary periods. This is where we're going. And it all comes into different cycles. A 50 to 75 year cycle, a 2 to 4 year deflationary cycle, a 6 to 8 recovery cycle. These are all the cycles, and they're short and long term. So I know this stuff is boring to some of you, but this is exactly what the guys that know what they know talk about. So spending is greater than production of good equals inflation. You guys should all know that. Rising interest rates always, not sometimes, not part-time, always leads to deflation. So what's going on right now, folks? Facts, only facts. The Fed, Jerome Powell, has come out, I can't remember how many weeks ago, and he said, we might see some pain. And what have they been doing? Raising interest rates. In March, not even last, but in March, Stephen and I did another 3-day training, just like we're doing this weekend. We're doing an amazing custom tailored 3-day to talk about what to do now, right now, and what's next. Not what we did in March. We're not doing the same training. This is a built one. But in March, we thought the Fed was going to raise rates about 0.25%. Seemed logical back then. How'd they do with that? Nope. 0.5%. And then after 0.5%, they went up more. I mean, look at the 3-day intensive money training that we're doing this weekend. All the things we cover: traditional financing, conventional mortgages, commercial banks and loans, and non-traditional financing. I mean, I'm not even going to read all these. This is everything that we cover this weekend. It might even be overwhelming for some of you, but we're going to take these items here that you see on the screen, and we're going to basically package them into 3 days that are only appropriate for what to do now. Okay? Because now is what's going to guide you to the next. If you know what you have to do now, that's going to lead you into the prep and everything you need for what's next. You see, creating wealth multiple ways, whether it's real estate, whether it's stocks, crypto, notes, land, foreclosures, pre-foreclosures, going to be a whole bunch of those coming up soon. So get yourself ready, because hey, all those days of being like, oh, I shoulda, I coulda, I woulda in 2010, 11, I should have bought those foreclosures. Well, guess what? You're going to have a bunch more to buy. So don't think that you missed out. It's coming back to a theater near you. Private funds, private loans, all of you are part of the 5% because you're here. You're willing to invest your time, your money, your energy. Actually, it didn't cost you anything to be here or last night. These are free. But to join us for this weekend is going to cost you money, $297 for 3 full days of knowledge. So back over here. Short-term and long-term cycles. These are what we need to know. But let's just go back to this one thing. Rising interest rates always leads to deflation. Here's inflation. You guys all know the chart. We love when it's going up because everybody feels good when your stocks are doing good, when your 401k is up every quarter you look at it or every time you log in, when the house prices next door, your neighbor house goes up, you go on Zillow and you're like, oh my God, honey, our house just went up $200,000 in the last 6 months. Feels good. but it always gives way to the next cycle. Deflation, hopefully not stagflation, but deflation. So now you go on to that same Zillow and you punch in your address and you look, honey, our house just lost $50,000 worth of value. And then your spouse comes over and says, yeah, well, look at our 401k. It's down 20% in going further. Oh my God, look at our brokerage account. It's down 15 or 20%. See, that's deflation. Doesn't feel good, but this is where we're going. And then when we really kind of get into the meat and potatoes of the whole thing, you can see the logic unfolding right before you. The Fed is raising rates. 3/4 of a point last time. December will probably be another 3/4 of a point because they can't get a hold of inflation. Now, when we talk about inflation, I want to get very crystal clear on what numbers we're talking about. Oh God, I got the pen in hand. So right now, this is where we're at. This is their target where they want to be. They want to be at 2. We are at 8.2. Folks, if you can do math, we got a long way to go. And the impact of what has already happened from an inflationary period and from an interest rate period is last year, okay? Last year, I think it was October of last year, maybe September, this rate, 3.5, was how much a 30-year mortgage would cost you, okay? 3.5%. Boy, those days are gone. A couple short months later, right now, I don't know where we're at. I think 7.15 is what I just saw. This is what a 30-year mortgage will cost you today. They want to get this to here. In order to get inflation from 8.2 to 2, they've got a couple tools. They call it monetary policy and whatever you want to call it. But one of them is this: interest rates go up. Now, for some of you, you're looking at that being like, well, what's so bad about that? I make more money. My savings account interest rates goes up. Well, have any of you looked at your savings account? How about your money market accounts? Have those kept pace with the interest rate increases? Oh, no. The banks ain't paying you any more money on your money, which is going to lead us to a really important topic in today's training of why you need to take back control of your money. Stop giving up control of your money to the banks. They're not doing you any favors. Now, let's just, here, let me go another page. I just want to piss you off a little bit. So remember, the Fed is raising interest rates. They're going to do it 7 times. So the next interest rate increase will be another 75 basis points, which should put 30-year mortgages over 8%, which also should mean that you will never get a car loan any less than 6 to 7%, which also means your line of credit will probably be 7+%. How you liking those apples? Should I keep going? Okay, you get the drift. Oh, wait. Oh, no, somebody said they want more. Okay, great. Your credit cards will probably be 29.99%. That good? We clear on what's going to happen? So all these costs are going up, but you've got your money in that traditional bank account. So let's just get this properly drawn here. Here's the bank where you go and you deposit all your money. You put all your dollars in somebody else's bank. I don't care if it's a money market. I don't care if it's a checking. I don't care if it's a savings. How much are they paying you right now? Can anyone in the chat, can everybody just tell me what you're making on your savings account right now? Maybe we'll get somebody that's getting 3%, 0.1. Okay, there we go. Katie Elliott's getting 3%. Keep going. 0.2, 0.1, 0.01. Okay. CDs are 2.75. So you guys got a grip, right? I'm not just telling you what they are. The highest that we had with a bank, and good luck finding one, is 3%. Okay, that was the highest that we just saw. So that would be a good rate right now. But most of you said you're getting 0.01 to, I think I saw 0.05. This is the average. This is an exception, and I'm sure there's some restrictions and things with that. But anyway, this is what you're making. Now, all the costs of everything went up, but yet they're still only paying you this. But yet every single time you go out and you work hard for your money, what are you doing? You're putting it in somebody else's bank. They're paying you, let's just say 3, but now they're going out and charging 8. They're going out and charging 6.7. They're going out and charging 7%. They're loaning your money out at those interest rates. This is the word of the day. Okay, remember we used to do that in kindergarten. Here's going to be the word of the day. All right, children, what does it say? Spread. Okay, remember, let's just use Katie's getting 3. They're charging you 8. What's the spread? We take 8 minus 3. So 8, 7, 6, 5. They're making a plus 5% spread. We all understand spread. Now, let's just do a real quick exercise here with the screen, because it's very important for what we're going to teach today that you understand precisely what a bank does. Now, the cool part, Stephen, this is awesome. And I want you to think about this. We've been doing the same presentation for almost a decade now. And we've always used the same interest rates. But we're actually getting pretty darn close. Even though we always have said that the bank pays you 4%, the closest we got is Katie at 3%. Okay, so we're not too far off. But what you've all been taught to do is take your money. You've been taught to go to the bank and deposit your money in somebody else's bank, because that's what we're taught to do. It's not because of any other reason. It's not because the bank is giving you some great interest rate that you're so excited to rush over there. It's not because the bank they used to give you dumb suckers, but I haven't found dumb suckers at the last 3 banks that I've been to. I guess they're cost cutting, so they cut out the dumb suckers, but they used to. They used to have coffee in the lobbies. I haven't seen that in a long time, cost cutting. So anyway, we just go to the bank because it's habitual habit. It's what our parents told us to do. It's what our grandparents told us to do. It's what everybody told us to do. But now let's talk about what that means to you. It means that you feel warm and fuzzy inside, because that deposit you made into the bank is an asset to you. You know that money's safe and cozy until it's not, until Lehman Brothers goes bankrupt, until WAMU goes bankrupt, until any other bank goes bankrupt. And they're like, oh my God, is my money safe? Oh, it's okay. There's the FDIC. Oh, wait, research the FDIC. They hardly have enough money to cover even a small run on the banks, but you still feel good about it. The bank does not just take your money and put it in the vault. The bank takes your money and loans that money out. That's right. The bank takes that money and moves that money and makes it work for them, because you allow them to do it. You gave them your hard-earned dollars, and the bank then does what banks do, and they make that money go to work. So they pay you 4 and they charge somebody 7. This is funny, isn't it, Stephen? Remember before we used to have to justify, don't get caught up in the numbers. These are just examples. Now I'm going to say, get really caught up in the numbers, because this is how much it costs today. Kind of weird, isn't it?
Double-digit mortgages possibly next year.
Absolutely. So the bank then loans that money out. The seller gets the money for the house and does what they've been habitually trained to do, puts it back in the bank. The bank immediately loans it back out on car loans. I bet you any money, if one of you go to get a used car loan, I bet you 8% is the new norm. Or if it's not, it will be next month, coming to a theater near you. Dealership gets the money, puts it back into the bank. You put a home remodeling loan on, you get a home equity line of credit, 9%, coming to a theater near you. Pay the contractors, they put the money back in the bank. You get up a bunch of credit card debt, and you get a call from somebody that says, oh, we can consolidate all that debt. We'll save you X amount of dollars per month. It's a trap. They're awful. But anyway, they charge you 12%, but it's okay, because 12 is better than 29 that you're paying on the credit card. So you take the debt consolidation loan and the credit cards, put the money back in the bank. Every one of these transactions, remember, it was your money that you put in the bank, our money, because it's all of our money that we put in the bank. Who was in control of every one of these transactions? You or the bank? The bank was. How much risk did the bank take to make your money go to work for them? Not much, all collateralized. They got a mortgage on the house. They got a lien on the car. They got a second mortgage on the house for that one. This is the only uncollateralized one, and that's why they charge you 12%, higher risk. So if we look at that, what did the bank do on every one of these? Remember, the word of the day, children, was spread. They made a spread. 7 minus 4, 3. 4 minus 8, 4. 4 minus 9. That's right. You're catching on now. We're getting a spread. Okay. This is all banks do. Banks make spreads on the money that we give them. So the bank, just if we did the math, made 20% and you made 4. You were psyched about the 4. There's not a person on here right now. Actually, let's poll the audience. So for every one of you, we got almost 200 people on here. For every one of you, would you be excited if your bank paid you 4% on the money that you leave in the bank? Can you give me a yes or a no? 20%, yes or no? Okay, Robert's a smart guy. Dave would be, yep, okay. Some people are saying no. See, some of the folks on here that are saying no have been around our campfire for a little while. They've been around this for a little while. So they're like, nope, I wouldn't be excited with 4. Smart. But for the most part, you know, wow, there's a lot of smart people. Or some people are just like, oh wait, he said no is smart. Let's put no. Right. 20 sounds better. So some of you are saying 20 sounds better. I love this, because if I did this just last year or the year before, a whole bunch of you would have jumped at the 4%, but now I love it. You're getting smart. So the bank made 20, you made 4. The bank made 5 times more than you did. If we take the 4 they pay you and divide that into the 20 that they made and the spread, that is a 5-time multiple, which means it's 500% more than you made. So now that we understand spreads and we understand how banks operate, which is the only thing I wanted to do with that slide, let's get down to some really simple things that you can play into right now with how the markets are working. So Stephen, let's do that mortgage thing. So right now, what we're going to do is we're going to talk about mortgages, right? So a year ago, not even a year ago, 3.5 30-year mortgage, 30-year mortgage is what it would have cost, and it would have been, let's just round the number. I think it was about $1,200 a month. And that would be if you put 20% down on a 300. Here, what we're going to do is we're going to pick on a house that was the average, just because these are numbers that are in my head. The average price of the house, what was it? 350, 588. There we go. Like this is just the median home price in this country, say 350. And this is a recap from last night. So we're just going to go through this quick. So if it was 3.5 that you could have done it last year, this year, right now, it's going to be like, I think 7.15. Okay, for the same house. So all of you can get this. It's called bankrate.com. They've got great calculators. So there we go. 350, 588. Look at that memory. Okay. If we did 7.14, so I got to drop a basis point here, 7.14%, 30-year mortgage. There we go. $1,892. Okay. So that's all we did. Same thing, same house, same price. There we go. 3.5, $1,259. So let's get our numbers exactly correct. $1,259 a month.
Let's say we had 10%, 2461.
Okay, so let's do that because this is where we're going. So let's look at what's next. 10%. And folks, don't think this is impossible. It happened in the 80s and it's probably going to happen again. Inflation isn't coming down fast enough for the Fed. So they're going to keep inflicting pain by raising interest rates and sucking money out of the markets. Okay, Stephen, so now let's just figure out the difference here, okay? Let's figure out the difference. If we take $1,892 a month minus $1,259. The difference from last year to this year, just with what the Fed's done, is going to cost you an extra $633 a month times 12. 633 times 12 means 7,596. Stephen, can you do the math for me? How much that would cost, or how much more this house would cost this individual that waited a year to buy? How much will that cost them over the course of a 30-year mortgage? So 633 more per month, 7,596 more per year. So we take the per year increase and then we multiply that times 30 years.
It's $227,880.
$880. So that same house that cost the same amount last year at 350, just because of the Fed's actions of raising interest rates, in 30 years, that house cost you $227,880 more because you gave up control of your money and because of things completely out of your control, which is Fed action. If that's the case, if that house went up in price, but yet you're a mortgage broker or you're a realtor and you're still drinking the Kool-Aid, believing that real estate prices are still going to keep going up like they have. Why? Well, because there's so much need. There's so much demand right now. Okay, so if you think of the needs and the demands of people, that is true. So any realtor you talk about, any mortgage broker, well, mortgage brokerage companies are going to go out of business pretty soon. Many of them, mark my words, unfortunately, a lot of the mortgage brokers that have made so much money in the prior years, if they didn't build a war chest and a reserve account, they're not going to make it long. Because, Stephen, what was the number? How far down are new applications for refinances and also new homes? It's
from last year,
50% decrease.
Yeah, at least.
I mean, we had that Tracy said 91%. So is that wow, 91% down.
Yeah, if you're looking from last year, that's probably right.
Yeah. All right, thank you, Tracy. I appreciate that. And you're right. HOA fees, I forgot to mention, those are going down too. Yeah, right. Forget HOA fees; they are going down too. Right. So everything's relative here.
It's a
All
joke.
right. So that was announced yesterday. Thank you so much. All right. So
We actually just had an HOA meeting. Every single bill that we have skyrocketed. Like even to the PO box doubled in money. Like everything is just so up right now. It's
I
crazy.
wasn't going to say anything about that. I'm like, shit, my HOA fee just went up. I just got the notice. It's like,
So I was joking. He said before, but property taxes and insurance are going down. Not.
Yeah. So how will this impact the rental market? Michelle's asking. Well, let's just talk about real estate as a whole. For all of those people out there that are still living in, I don't know, 2020, 2021, where they think that the price is going to keep going up because of needs and demands, they forgot mathematics. Because everything I just showed you, the Fed increasing interest rates is going to do one thing. It is going to make it so that the people that could afford that median home price, 350, 588, can no longer afford the same house. Nothing changed in their income. Actually, they're making more money than they did last year. They got a raise because of this inflation. They still can't afford that house. It wasn't because anything changed. It was because outside forces called interest rates and the Fed and monetary policy changed, which means we just heard this, Stephen. We did it in WTF. Somebody that could afford a $400,000 house can now only afford a house that's like $277,000. Do you remember that?
Yeah, I think it was Todd. Todd, did you say that, or is it
Todd, did you say that? What was the numbers on that? Because that would be some good data to have here. But anyway, once we're waiting for that, what it basically means is the people that could afford a $350,000 house last year can no longer afford a $350,000 house. They might only be able to afford a $299,000 house. How much inventory do any of you see in your area? I live in Buffalo, New York, not the greatest place in the world, but 299,000. How many houses do you know for 299,000? Well, I know I just sold a completely redone flip. It was a 1,200 square foot house. Now, it did have 4 bedrooms and it did have 2 bathrooms, and it was redone. We got I think we got like 316,000 for it in Buffalo, New York. So how many $299,000 houses are there out there for all these people to buy? Not many. It doesn't matter what demand is, because if demand doesn't equal the price, then if the affordability doesn't equal the price, then it doesn't make a difference. So the price of real estate has to come down. The price of rentals has to come down, even though they're rented. The same rules apply. Because the last time I checked, I don't know many people out there that are just going and paying cash for big rental buildings. They're financing them. And guess what? Their cost just went up. So because their costs went up, they can't buy as much property. It's just mathematics, which is why Private Money Club was created, to be honest, to solve some of those problems. And boy, to talk about timing, we nailed it. So all I'm trying to explain here is the price of real estate has to go down. And if the price of real estate goes down, let's say this is a 4 unit that you could buy last year for 650. Right now, you can buy it for 600. In a year from now, you might be able to buy this same property for 500, maybe even lower. You see, the price will continue to push down as the interest rate goes up. So if interest rate goes up, the price of real estate, because of just mathematics, will automatically start to deflate and come down. How many of you would love to buy a 4 unit that last year cost 650 for 500,000? Anyone? What if it came down to 450,000? Anyone want a 4 unit for 450? Everybody's got a price, right? It depends on your market. Maybe that's a good deal in your market. Maybe it's not. But nonetheless, if it used to be 650 and you could now buy it for 450, and the only thing that's changed is the Fed's actions, doesn't this create a unique opportunity? And then we didn't even get into the fact that as interest rates go up, what about those variable rate mortgages? Oh, I thought those ended in 2008. Nope, they're around. Oh, what about the subprime market? Oh, it's still large and in charge, folks. You thought all these things ended in 2008. They just repackaged them and called them something different. Okay, it's the same game going on at the banks. So when all this stuff explodes, oh, and by the way, the subprime market right now is exploding. I've got the inside touch. What you're also going to have is you're going to have a whole bunch of foreclosures. Okay, a lot of foreclosures. You're going to have one thing, and that's called opportunity. But you know what's going to really screw your opportunity plan up? Is not having access to capital, not having your money in the right place, not being in a good financial position. And that's what we need to address. This is the summary of exactly what we're going to talk about deep this weekend. We're going to go deep into this opportunity right here. But you see, let's go to another page. The opportunity that I just mentioned, I just did one side, okay? So here's what the opportunity is going to be. The opportunity is going to be in the form of real estate with much lower prices. The opportunity is going to be in the form of stocks. I don't even care if you say your favorite company like Apple stock, the gem, these are going to go on sale. Okay, everything that you might want to buy. Maybe you want to get into Turo and you want to start buying cars. Yes, the price of cars are going down. Don't believe me? Carvana more than likely will not make it through this economic cycle. They're already struggling. It'll be anyone's, maybe they get gobbled up and bought, but chances are they're all going to have some serious pain. But you know what? Jerome Powell said there is going to be some pain. And people sometimes when you think of pain, I don't know, grab a pin and poke yourself right in the center part of the palm. That would hurt, right? That pain. But there's also pain of when your business folds or starts hemorrhaging money or starts bleeding money. There's also pain when your real estate values go down when you're trying to sell them. There's pain when you get your 401k statement or your brokerage statement and your stocks have dropped 30 to 40%. That's pain, but we don't think about that. The pain when you paid $100,000 for a car that really wasn't worth 100, but you had to have it. And now it's worth 60 and you want to sell it. Pain. To one person, all of this is pain. To me, Stephen, and all of you, the 5%, this word becomes opportunity. Sorry, had to spell that one out as I write it. You notice how I changed that up? For one person, it was pain. For another person, it was opportunity. Opportunity to buy stocks severely on sale. Opportunity to buy vehicles that you can then Turo for income severely on sale. The opportunity to build a rental portfolio, a real estate portfolio severely on sale. The opportunity exists for those of you that are prepared. What does preparation look like? BYOB. And we got a special offer for all of you guys today that I want to just quickly announce. This is a skateboard deck made by Penn's Wood. These are limited editions. Some of you grabbed these, 19 of you, if you were on last night, maybe took advantage of this. We got these decks. We got brand new hats we just came out with, BYOB, Be Your Own Bank. So if you join us this weekend for the event, we're going to give you an opportunity to get a skateboard deck or a hat or one of the shirts. We got a whole bunch of shirts. I mean, maybe you don't want a hat, maybe you don't want a deck, but maybe you want a shirt that says, either you run the day or the day runs you or various other ones. We're going to give you all of that stuff just for joining us this weekend. So we'll get to that, but I just wanted to pave that. So let's get into.
Hey, Chris, one thing to hit on before we jump into the BYOB, just somebody was talking a little bit about, hey, rental properties. They said, no, they think that rent payments will come down and therefore the properties will not cash flow. Just want to hit a little bit about when foreclosures occur, what people are forced to do and what rent prices do. And especially when you look at multifamily and complexes and I mean, looking at 08 and history and what that looks like real fast.
All right. So the first thing that's going to happen, it's called capitulation. You're going to have rent prices come down. Matter of fact, it's already happening because if people have less money because the Fed raised interest rates and sucked money out of the capital systems because people lost their jobs. Just this morning, we had a bunch of people say that they just got laid off, and Meta, Facebook, as you know it, just laid 11,000 people off. So those people have less money, right? So they live in that really nice penthouse, but now they're looking for a lower price apartment unit because they can't afford it. Rent prices in the early stages of a recession will go down. So you're right. So anybody that's been buying these rental properties that has had really high hopes of rents continuing to push up like they have over the last couple of years because of demand, they're going to be a little upset. So you should, when you run your pro formas, expect about a 10 to 15% drop in your rents. But I don't want you to get spooked by that. I just want you to make sure that your property can sustain a 10 to 15% drop, because you already know the price of your property. If you paid $600 for it last year, in a year from now, it might only be worth 400. I'm just making numbers up. I don't know that to be fact, but let's just assume. So you lost the opportunity to earn money by selling it for an appreciated price. That went the opposite direction. Remember, that's called deflation. Okay, deflate. Just think of the tire. But now all of a sudden, the one thing that you didn't think was going to happen happened, and that is your rent went down. And now all of a sudden, you probably are having a hard time sustaining that property. Maybe you can't afford to pay your bills because you ran it one way with a model that everything was going to go up, but now everything went down. You can't support it. This is what Kathy's talking about. Again, pain for one person, opportunity for another. This person very well might have to fire sale that property if they can't sustain the dropped rental. But then once the opportunity comes up and somebody buys it for the lower price, fire sale, because this person's got to get out quick. One thing that will happen in the later stages of the recession, there will be so much demand for different property types, not the A type, but the B's and the C's. There will be lots of demand. Rent prices will then start to push higher. And they'll start to push higher because people will lose their houses. 2008, 2009, 10, 11, rent prices were going up a lot. And that was because the demand from the people that were losing the houses because they couldn't afford them. Maybe this person that owned this rental at 600 lived in one of the units. Now, all of a sudden, they don't have that unit to live in anymore, and they need to go find another place. Demand pushes price up. But you're going to have a decrease in a lot of the properties, maybe not B's and C's, but definitely A's, that will then be followed by an increase in rental price. But you got to be able to make it. You got to be able to fall, to pave the way, or what's the word, sustain through that period of time.
And keep in mind, rental prices move very, very, very slowly because typically they're at least a year lease. So you're not going to change any amount you're paying for at least a year. So as prices come down, you still have these long-term leases in place. And so that's, it takes time for these price adjustments to occur. And typically rents just don't come down, period. And, especially now with all the Airbnbs that people are using houses for, and all the people traveling using Airbnbs instead of hotels. I mean, that all goes into it. And then just over the last several years, all these big hedge fund companies and all these big, large corporations are coming in buying residential real estate, which is driving that market as well very strongly. So all this stuff's happening. So I don't see rent prices coming down, at least anytime soon, even in a recessionary time. It just doesn't make sense why they would or how they could. And just one more thing, just right, Chris, just to kind of keep going with that for one more second. I think it's a great conversation is, this is someone asking for opinion from Kathy. Will prices go down with the rate at which the hedge funds are buying, or will everyone who is priced out be forced to rent from the hedge funds?
Great question. So the hedge funds are already slowing down their buying. If you know any wholesalers, real estate wholesalers, start talking to them about the hedge funds that used to buy everything that they would put under contract. They're not buying as much anymore. You see, hedge funds are Wall Street money. When Wall Street starts this hemorrhage, when the Fed starts sucking that money out right now, the tune of $95 billion a month being sucked out of the capital markets, there's less money for hedge funds to buy. And hedge funds already had their heyday. They bought a lot and they're still buying, but that will slowly start to diminish. So the hedge funds that were there for all the buying, the wholesalers to sell properties to, that's going to slow down. So that's going to hurt wholesalers in the interim. Wholesalers can still make a lot of money, but they can't get reliant on just hedge funds buying their properties. Secondarily, what you were just saying with that is once the hedge funds have bought up a lot, who's going to be the one owning the single family houses? Well, it already is. A large amount of houses are owned by hedge funds. Those hedge funds rent those houses out because of what we just talked about. They understand this model. They don't so much care about this because it's just a balance sheet item. You'd have to have worked on Wall Street to understand how Wall Street thinks. Wall Street doesn't really always care about the drop in price if they've got the cash flow to support their investors. So if they're getting a 10 cap on their properties, a 10% return, and they promise their investors 3 to 5% with an upside, and that upside would come when this flips, they got time. Their investors aren't looking for huge returns. They're making, what was the word of the day today? A spread. So if the hedge fund pays their investors 3 to 5 and they make 10, they make a 5-point spread on billions and billions of dollars. That's how they operate. Now, here's the thing you need to understand with Airbnbs. It's kind of the same thing. We'll just do Airbnb, okay? It's the same thing that we just talked about with real estate. A lot of the houses in the real estate that was bought to Airbnb, the price is going down. That might not be a big deal because if you can book it and still make your money, that's great. But the problem is with Airbnbs, during this whole thing, when it sets in, remember, everybody else is going to be going through this deflationary period, which means everything they own is deflating, which means people are going to get laid off. Okay, already happening. Every day, you're probably going to see it in the news. Another company laying people off, whether it's IBM, I just saw AT&T laying people off. We all know about Meta's 11,000. We all know what Elon Musk did with Twitter. Pretty much just said, you're cool, fuck you, you're cool, and just fired 900 and some people. Good for him. Like probably needed to happen, but anyway, not going there. So people are going to get laid off, and when they get laid off, they have less disposable income. Airbnbs are a luxury item. Okay, they're a luxury item with a luxury price. Not all, but some have a luxury price. So, you know, like we got a guy on our team who does a lot of luxury Airbnbs. My thought, my opinion solely on this is that the price per day, the rental price per day will go down significantly. So when you're doing your Airbnbs, make sure you stress test, especially if it's a luxury Airbnb, make sure you stress test that rental, see if you can withstand a 15 to 20% decline in booking, and then see if you can sustain not just the decline in booking days, but the decline in booking price. So you're going to have to stress test your Airbnb to make sure it makes sense. But I still think this is a viable model. I just think we got to be really careful with the numbers. A lot of people got caught up in the Airbnb craze this summer. Please, please, please remember this summer is deemed revenge summer, and it will go down in the history books known as revenge summer. People wanted to travel. If any of you were in an airport anytime in the last year, it's hell. It's packed. Every flight's oversold. Everybody's pushing and shoving. Everybody's upset. You can't even get a damn seat at the restaurants in any airport. Well, at least I haven't been able to. So that's all because people wanted to go out and travel. They wanted to go out and make experiences because they were locked up for COVID for too long, which drove the price of Airbnbs, especially luxury ones, up. But nobody really thought, whoops, what happens when people lose jobs, when the markets go down, when everything goes down in price and people don't have the disposable income? What does that look like when the price of that goes down and the rental goes down? Because not as many people are going to be traveling. It's not going to be revenge summer. It's going to be revenge to just keep the house over your head, revenge to just keep your car payment going, revenge just to keep your household floating because everything else just deflated around you.
Chris, like when it comes to working with investors, like let's just talk private money club, for example, right? Yep. So if I'm lending my money to an investor that's going to use my money to go out there and do real estate, and their business model is Airbnbs, I'm good with that. But I want Airbnb to be their secondary exit strategy, meaning they're going to do Airbnb while they're making money, but when Airbnb's not making money, they do have an alternative that they can pivot to use to either cash flow or sell that's still going to allow them to make money. Because I agree with you. I think Airbnbs are going to come down. And I think there's gonna be a lot of people stuck with those things that are going to be negative cash flow for a while. But if you get into them knowing, hey, I'm going to do this cash flows even as a long-term strategy, a long-term rental strategy, but right now I can make more as a short-term, I'm good with that. But make sure you have that alternative strategy. And
like with an Airbnb on the lending side, like even though all this stuff looks negative with real estate and going down in price and decrease in rentals, it's an awesome time to be the bank. It's an awesome time to be a lender. I lend a lot of money on Private Money Club, but these are the things I'm looking at. I'm getting a little bit more strict with my underwriting. I'm not lending 100% on deals. Okay, I'm looking for multiple exit strategies on every deal, especially Airbnbs. Great. Let's look at the numbers for Airbnb. Let's look at what they look like, 15 to 20% lower than what you're projecting. Okay, let's look at if you can't Airbnb it to sustain it. What if we just do a regular 6-month or 12-month rental and the rents are going to be this? Can that support you paying me? Because that's all I care about is, am I going to get my check? And if all goes to hell in a handbag, what price do I think you're going to be able to sell it for? And if I lent you 70% LTV, loan to value, okay, based on an appraised value, do I think this house can support a 30% drop and me get out and get my money back? So I'm just looking at deals differently. And I'm also looking at different types of borrowers like developers and people that have existing networks. So it's just the dynamics changing, but it's actually getting more exciting if you're the person with the money, because pretty soon you're going to be the one person everybody needs because you got the cash, right? What is it? Thy with the gold makes the rules. I know I'm going fast here, folks, because I got a lot to pack in and I'm just brushing the surface. All of you are probably thinking, oh, go deeper, go deeper. This weekend, we're going to go really deep. You got to understand, this is a preview event for what we're going to be covering this weekend. Just to lay it out, just to give you an understanding and an idea, this weekend, we're going to dissect every one of these pieces because I've got 3 days with you this weekend, not just an hour and a half that I got to finish right on time. Here's what I want to ask. How many of you right now, today, have equity in your house? Lots of people. All right. Now this equity is going to vary, for all of you, and it's going to vary different amounts. But let's get into really thinking like a bank. Each one of you right now has a luxury, because this is a luxury that may not be there tomorrow, and it's called equity. Just because you have equity in your house, just because you feel good, that equity next year might be significantly decreased, or your ability to tap into that equity might be gone forever. So this weekend, we've got a speaker coming in who's really going to explain how to tap into equity a little differently than most of you would normally do it. So today, I'm just going to hit on one thing. I'm going to hit on HELOCs. Okay, we talk a lot about them. We've got a specialist who's going to be coming on this weekend. We actually call him Mr. HELOC, and he's going to be talking about a different strategy that most of you have probably never heard of on how you can use home equity loan agreements. Okay, a little different than home equity lines of credit, and how you can use them to create a whole unique banking system that then, if you want, you can add the engine, which is the specially designed whole life, which I'm going to cover last today. We're going to really dive into that. But I want to hit the equity part because this is vitally important. If you have equity in your house and you have not gone to your local bank, your local credit union, or your local community bank and gotten a home equity line of credit, I have to ask you why. Why haven't you done this? Number one, it could be laziness. I haven't gotten around to it. I was thinking about it. I just hadn't done it, because there is no cost for this. The cost is just your time to go to the bank. You could even call and get everything set up. The bank typically will absorb the appraisal fee. They normally don't charge you that. The only thing the bank's going to charge you is interest on and that's actually simple interest as long as you do it right. If you're going to do a home equity line of credit, never ever buy into the fixed interest rate. I know they're going to tell you, well, rates are going up, so you might want to fix this. The difference is amortized loan payments versus simple interest loan payments. And what was the word of the day, folks? In the chat, really quickly, what is the word of the day? Spread. If you're paying interest and principal back on an amortized, you're losing the spread game. You can't make the spread. How do I know? I have clients that have done that. So we want the option where all you're going to pay is the interest on the loan, simple interest. So today, home equity lines of credit are about, let's just round up. It's actually about 6.5. So let's round up to 7%. That's a lot higher. Last year it was like 3, but we know things are going up because interest rates. Okay. So in the middle, the word of the day, I'm just going to put it right here. We're going to play a little game. We're going to play the spread game, and we're going to do this 2 different ways. Okay. You got 7% that it costs you to use the equity in your house. To get the home equity line of credit costs you 0, but your time. But the reason you haven't done it is, I don't know, you have your own reason. And I'm going to tell you why you're going to do that this week. Because what if next week, and this could be real, what if next week you couldn't get the equity out of your house anymore? What if next week the value of your house plummeted 30%? Now, I doubt that's going to happen. What if next week your bank, no bank, was issuing lines of credit like Citigroup, and I can't remember all the banks during the pandemic, they froze lines of credit. I think it was Wells Fargo. What if your house dropped and banks stopped lending and you no longer could get the equity? Would that motivate you to go out this week to get it if next week you couldn't get it anymore? I need you to think that way, because urgency is very important right now. So you need to understand that even though you have equity today, which most of you said you did, you might not have equity next month, the next 6 months, you might not have equity next year. So if you don't tap into this now, you're missing out. Now, let me give you other motivation for the word of the day. Most everybody on this call has different debts, right? Most of you probably have a car loan debt. Some of you actually, like Steven, you guys have a boat loan. Just kind of make that a boat. Some of you have credit card debts. Okay, maybe you got a fancy credit card that you did. Maybe even got a couple of those things because you had to have the Amazon card. Oh, when you were on American Airlines, you had to get another card because they were going to give you those 100,000 miles. So you racked up all these cards. Now, because interest rates have gone up on credit cards, interest rates have gone up on loans, all these credit cards, which started at 0%, are now going to reset at probably around 29.99. Okay, the 0% interest rate, you're not even going to hear about those soon. Might still have one, but when it ends, get ready because the show begins. So let's just say it's 29, 15%, and we'll do another one at 21%. Maybe you got one at another 15, and then you got a really good one down here at 8%. So here's let's just do the math. Car loan, let's just say it's 5%. Boat loan, 6%. and then we'll do the credit cards. So I'm just going to do some math. I'm going to add up all your debts, and I'm just going to do the interest rate. We got 5% for the car. We got 6% for the boat. We got 29.99 for the first credit card. We got 15 for the second credit card, 21 for the third credit card, 15% for that other one, and then you got an 8% community bank credit card. So we've got a total of all those interest rates of 99.99. Okay. Now that was 1, 2, 3, 4, 5, 6, 7. So what we're going to do is we're going to divide that and get the average by 7. That means your average interest rate for all these debts is 14.28%. Okay. That's what you're paying out. These exist today. You're just used to paying them. These are your debts. And what did I say earlier that's going to crush you in a recession? Your debts. Okay. Especially these ones, the credit cards, these are going to crush you. Your car and your boat loan are also going to help crush you because those payments are higher. You got this equity sitting in your house. You haven't done anything with it. You're like, I don't know. And then, interest rates went up. Oh, it's too expensive to use that money. Really? Because just a second ago, we went over all your credit cards and you've got an average of 14.28% that you're giving away to somebody else. All of your money on this side is leaving your family every single month and going to their bank, not your bank. Okay. So now what we're going to do is we're going to take whatever equity you have. Let's just say we got $100,000 in equity in your house. Okay. That means you're going to get $80,000. Whoops, not 80%. You're going to be able to get about 80 to 90% of that money. And yes, we do have banks that we work with that do 90% of the equity in your house still. So if you need help, Mr. HELOC knows the bank that does that. But let's just use 80. Okay. So we take the 80,000 from your home equity line of credit. And I'm going to show you a risk-free way to make a spread. We take the 80 grand at 7%, which you were just bitching about that 80%. And what we do is we put all of your debts in order. And let me just show you something. I want to show you how I would want you to do this. We're going to put all of your debts in order from lowest balance to highest balance. Right here, folks. This is a great, depiction of that. Notice how these debts are put from lowest to highest. And the APR, the one, a lot of people want to pay the highest interest rate off first, but when we're doing a debt snowball, Dave Ramsey's concept, it does work. When we're doing a debt snowball and paying debts down, it's always best to start with lowest to highest, regardless of the interest rate. Because what we want is we want the ability, folks, to recapture the monthly payment. So we have the equity, we took the equity out, we shifted this 80 grand over here, we paid off all of these debts. We created $2,200 a month in money that was giving away. And what we're going to do is we're going to take that $2,200 a month and we're going to basically just apply that over here to pay down the home equity line of credit at 7%. Okay. All we did is we paid these off and we then took the monthly amount that you were giving away and we shifted it. Nothing changed in your cash flow. You took money you used to give to somebody else and you now pay it back over here to the bank that gave you the home equity line, but the home equity line is your house. So your house, technically in this example, is the bank. Let's just look at the spread in the middle that you made. We take the average of the 14.28 minus the 7%. You just made yourself a 7.28% positive cash flow. So you literally, if you really wanted to kind of get silly and you're like, hey, we need some extra money, we want date night again, we want some extra cash to send our kid to private school because now that they're mandating certain things, we can't send them to the regular school. So figure out $2,200, or you can do it any which way, $2,200, and then carve out the 7.28%. Okay, so let's just say you now created 1921.92. Okay. This is your money. This is your fun money. This is your date night money. Okay. Now it doesn't seem like a lot, but it's money you didn't have. You created $2,200 a month, and that works out to be $1,900 extra if you just kept the spread. Everything else, now you're paying this off, and you're going to pay this home equity line down really fast because it's being paid down at 14.28. But if you carve this out for the fun money, you're just taking the spread and enjoying it. Does that make sense? Two different ways. You could just say, screw it, I'm just focused on getting rid of debt. Great. The whole $2,200 goes back over to refill the home equity line. And then this money, now what we get to do, so this is where it gets super fun. So everybody understands the spread we're making. You understand you're taking the $2,200 every single month. You're putting it back to the home equity line. But you see, we're not going to stop there, because if you're the bank, as this home equity line builds back up, You had 80, you took all 80 out, but now you're making $2,200 payments. So let's just say after a short while, you got 20 grand and then you got 40 grand the next year. And you're saying, okay, well, now I got 40 grand in equity. What are we going to do? Let's send that money back out. Let's find a deal on Private Money Club and let's lend that money out at 12 to 15%, the average rate that most of the deals are getting on Private Money Club. You see, all you're doing is refilling the pot. You're just refilling the bucket of money. Now, in this case, the bucket of money was the equity in your house. One more thing. Okay, we're doing good on time. Any questions you want to ask on that particular one, Stephen? Anything we need to flush out there?
Yeah, maybe one, just hit on, how to handle debt interest rates if they're if they're lower than 4%. Let's say all the debt is just stuff that's under 4%. Like, what would you look at that way?
Still cash flow. So if all the debts are under 4%, then the math wouldn't make sense for this. So now let's go. So if it's 4%, you wouldn't do this because that would be a negative arbitrage, a negative spread. Okay, so if all your debts are 4%, we're going to then have to shift from using the equity in your house to paying off those low interest rate debts to now paying them off with your banking system, your specially designed whole life, which I'm going to cover in a moment. But there's one I wanted to get before we did that, because now we understand this model. We understand how we can keep recycling and keeping that money working for us. And I want all of you to then remember back to when I showed you the bank and how a bank works. Do you all remember that? The bank, all they do is you deposit money in the bank moves that money back out. All we're doing is depositing money, in this case, back in the home equity line, and we're removing that money back out. Everything I'm showing you is banking 101. We just constantly want to keep that money moving. So that was the house, the equity, everybody said. So here's the next question for the audience. Okay. How many of you have a 401k, a 403b, a 457 plan, or even, an RSP or some type of qualified retirement plan at the job you work at? Put I in the chat. So now I'm just going to call this a 401k just because everybody knows what those are, but these are just qualified retirement plans. Okay. QRPs is kind of what we always call them, qualified retirement plans. It's a retirement plan set up by your employer. Now, if you're still working, and now this is only going to apply to any of you that are working at the company where your 401k is. If any of you have an old 401k, an old 403b, an old 457, or an old TSP, because you were a teacher, old retirement plan, if you left that retirement plan at your old jobs, like plan participant or plan, oh my God, why am I? Plan administrator, whoever did it. So let's just say principal was who did the 401k. You've since retired and left, but you left your money at your employers. I just got to ask you a question. Are you crazy? Like, you packed up your desk, you packed up pictures of your family, you left your money at your old employer? Get that money rolled into a self-directed IRA. We're going to go deep and cover that this weekend. Self-directed IRAs give you lots of options, or just the same options you have now for less. They're way more flexible. They put you back in control of your money. So I just kind of did that just because somebody had mentioned a teacher retirement plan. Now, if you mean a pension, this is different. So 401ks, here's the cool part. Most 401ks have a loan option. Okay, which the loan option, depending on how much money you have, says one of two things. We had a field day during the pandemic, but right now we're back to the old rules. You can take a loan from your 401k for $50,000 or 50%, whichever is greater. Okay, so up to 50 max or 50% of your balance. So let's just use $50,000. Okay, we're just going to use that because it's simple math. Now remember, we just did that home equity line of credit. Now let's say over here. Now we've got a bunch of debts, and now I'm going to use that example. Say we got a bunch of debts that are 4%, 3%, 5%. Maybe you got one credit card that's 10, but almost all your debts are 4%. Now that wouldn't have worked for the home equity line because the home equity line of credit charged 7%. So you had a negative spread. But here with your 401k, you have the ability to take a loan for $50,000. And let's just say all of these debts, I don't know, let's just make this simple. They all amount to 50 grand. Okay. So what we're going to then do is we're going to take a loan from our 401k. And then we're going to do the same thing. We're going to snowball all these debts, lowest balance to highest. We're going to pay off the 4%, pay off the 3, pay off the 5, pay off the 10, and pay off the 4. And let's just say all of those debts work out to be we'll just do it over here, $1,500 a month. I'm just making stuff up here. Okay. So we'll put, this is how much you were giving away for all those debts. but you haven't paid these debts off because the interest rate was so low. You thought the credit card and the debt company and the bank was doing you a huge favor. So why ever pay them off because that interest rate is so low? But you got your money sitting over here in the 401k. The last statement you got, you were down 20%. This is classic. This is critical thinking, logical thinking. If we take a loan from our 401k, that means that $50,000 has to come out of Wall Street and now be deployed. Wall Street, is anyone in their 401k right now, to be honest, anyone in your 401k upon today or your last statement, is anyone making 4% right now? Thinking there might be one that's got like a stable value, but those aren't even paying 4%. Okay. So we're clear. Nobody's making 4%. Matter of fact, everybody's got a little negative in front of what they're making in their 401k. So 4%, if you were making that in your 401k, wouldn't be so bad, right? So we take the 50 grand out of Wall Street where you're not making 4%. We shift it over. We pay off the debts, which keep you up at night. And then what we do is we then take the $1,500 every month that you were giving away to the debts, and we then practice banking. We pay the money back to your 401k. When you take a loan from your 401k, there's a couple things you need to understand. First off, they're going to charge you an interest rate. I don't know what it is, but let's actually just redline it. Let's say it's 6%. So this is the interest rate that the 401k is going to charge you to use the 50,000. How many of you still think this is smart? If it cost you 6 and over here you were paying, let's just average it out at 4%. Most of you would be like, oh, that doesn't make any sense. Why would I pay 6% for the loan from my 401k to pay off these low interest rate debts that I just told you, I didn't pay off because they were so cheap. And now you're telling me to use more expensive money. Hold on. In a 401k, when you take a loan, they're going to charge you interest. Okay. They're also going to make you pay a payment every single pay period. The payment is no big deal because the payment's going to be supported by what you were giving away for the debt. So that's a non-issue. Matter of fact, you're coming out ahead. This is something that I catch a lot of people on. Can anyone tell me who the 6% interest is paid to when you take a loan from your 401k? That's right, yourself. So you already know this. Why am I teaching this to you guys? You already know this shit. So the 6% interest is put back into your 401k. So now you all just said you're not making 4% on your 401k. So it would make sense to take money out of Wall Street, out of those mutual funds, and put it over here, pay off your debts at 4%, because now you're making 4%, which is better than making negative something. But now, because your stupid 401k company makes you pay interest, now you're not just making 4, you're making 4 plus 6. You're now making 10%. Guaranteed. And all you did is just shifted where your 401k money went because you lost faith in Wall Street. You got scared because your account was going down, but you had all this debt. I don't give a shit if you got a car loan. You got a car loan when car loans were good. Hear me out on this. You bought a car loan and you're one of those people that always comes on to our trainings like, my car loan's 0%. I'm not paying that thing off. Why wouldn't you pay that stupid car loan off even at 0%? Because at 0%, it doesn't matter. That money is going to someone else's bank. By doing this with your 401k, whatever your car payment is, $500, we'll call it, that 500 goes back to you. And you make 6% doing that. You make a 6% positive spread there. Or in the other example, you made a 10% spread. I know how people like to dip out early. Let's get this out of the way. I'm going to pause because I got something really cool I'm going to show you in just a second. Let's just get the hard part out of the way. I'm going to sell you something, and I suck at selling. So this is a skateboard deck, a limited edition. Okay. There's only 50 of these. We've got, last night we did 19. So I don't want to overpromise. I think I've got 10 of these left. Maybe there's 12 left. I didn't count. I should have. So let's just say there's 10 to 12 skateboard decks left. Okay. They're all numbered. Once they're gone, they're gone. Nobody's ever going to get this again. So you could put it on your wall. You could gift it for Christmas if you got a kid that likes to skateboard or a nephew that wants to skateboard, or you could just say, I got a limited edition BYOB skateboard. Okay. Maybe you don't want a skateboard. Great. Maybe you want a hat. We've got trucker style hats. We got regular style hats. We got these really cool ones that are incredibly popular right now. That kind of bring back like the 60s and 70s. And we got t-shirts. You can pick one, not all. You can pick one of these. So you guys can come this weekend. Now, some of you have plans, you have weddings, you have all sorts of stuff. Great. We record these just so you know, we're going to record all 3 days, but we're not going to just record it. We have a really good editor that we pay after we're done doing all 3 days that takes them and edits them into sections. So go down to all the different speakers. So imagine if you wanted to come to the 3-day, but you really, really want to learn about all the stuff we talked about today, which will be Friday. Okay. Friday will be recorded and broken up into multiple sections so that you don't have to spend an entire day watching a recording. You can literally just watch just the section on what you want to learn and apply right there. That's how we do our recordings and our editing. It costs us a lot of money to edit these videos, but you will get the recordings. Not only that, you're going to basically have access to all of our speakers, okay? Which there's going to be special offers on all of our speakers. I mean, people come to this event every time because every time it's different. I mean, the testimonials are on there. This event's $297. So, Stephen, real quick. Oh, yeah, I forgot all the bonuses that we give. What are we giving them now?
They'll get them all.
Yeah, you get a whole bunch of bonuses, but it doesn't matter. Like, let's just get you the hat or the skateboard deck. So you're going to click reserve your seat. Now, this is today only. So I did this last night, but this is the last preview. And after this, we're not doing it anymore. Today only, you can get this not for $297, but for $197. And pick the skateboard. So all you're going to do, folks, we're going to give you the link in just a second. You're going to go in here, okay, when you get the link, and you're going to click on this, have a coupon. Yes, we're going to give you $100 off coupon, which means you're only going to pay $197 for all 3 days, and then get whatever one of the swag gifts you get. You give all your info, it'll be $197. But the very important thing is after you put the coupon code in, the price will adjust. Go down to the description. Down here in this section right here, additional information, other notes. If you want a t-shirt or a hat, please tell us for the shirt, your size, and whether you want white or black. Okay, those, and I got other shirts. But if you don't care about the color, just tell us your size. And if you want a hat, just tell me you want a trucker or a solid color. And if you want a deck, just put in skateboard. That's it. Those are the only things you need to remember. Skateboard, trucker or regular hat, and then size of the t-shirt. That's it. And we will mail it to you. Matter of fact, Shauna will probably make sure that I'm the one sitting here on a Saturday packing them all up. So now we got the offer out of the way. We're going to put the link up there. If you guys want in on this, it's a ridiculous deal. I mean, the skateboard alone, they sell for $60. Okay. Sold a whole bunch of them at $60. So you're getting a $60 deck, and then or a hat, which we sell for $30, and t-shirts we sell for $25. So there's the valuations you're getting, plus the value of the training will save you maybe thousands, maybe tens of thousands, maybe millions. So this brings me to the very next segment of what we're going to do. You saw how you can be your own bank. You understand the problem. You understand the opportunity that's coming. It's going to be pain for some, opportunity for others. Now what you need is the solutions on where that money is going to come from. We did home equity lines. Okay. So that's where some of the money is. We're going to teach you other ways to get money from your house without having to take out a loan. There's different ways to do it. We'll cover all that this weekend. We talked to you about 401ks, how to take a loan from your 401k and how to leverage that money out of Wall Street to make a positive spread, and how to do it even with low interest rate debts, because that's the way you do it. But now we're going to talk about the ultimate. So the code is virtual discount right there, James, right up in that link you just put up. Virtual discount is the coupon code that you'll put in. It's right in that description there. So the ultimate now is something that we teach a lot. And it's going to involve a change. Okay. So you're going to have to change one thing in order to do this. You're going to have to change where your savings goes first. We already discussed how crappy banks are. You know, banks are raising the interest rate on every loan they have, but they're not paying you any more money unless you're Katie, who's getting 3%. She found a really good bank that pays 3%, but that is not guaranteed. If the Fed drops interest rates, her interest rate on her savings is going to go down. So let's just talk about just the money that you guys keep in banks, okay? And we can expand from there. We just want to change where that money goes first. And what we're going to do is we're going to put that money the exact same place that the banks put their money. Because if the banks are so darn good with money, then why wouldn't we just copy what a bank does with their money? And I'm going to prove it to you. Here's FDIC.gov as of September 30th, 2021. So this is over a year old. This is where banks put their money. These are only the top 5 banks. But you know these names: Bank of America, Wells Fargo, JP Morgan Chase, US Bank, PNC Bank. This is how much money these banks are putting in this vehicle that we're going to talk about, a specially designed and engineered whole life. The banks call it BOLI. BOLI, Okay, you can Google it, you can look it up. I'm not telling you something that's not 100% factual. BOLI stands for bank owned life insurance. The single solitary reason when you walk into a bank, everybody seems to be a vice president is because the bank wants to buy more whole life. And to buy more whole life, they need bodies to insure, but they can't just insure everybody. They can only insure executives of that bank. So let's promote everybody to a VP. Then we can take out a policy on every employee that is a vice president. And that is how the bank puts $75 billion into whole life. Now, please, please, please do not be caught into the lie. Some people out there on TikTok specifically, I'm not going to give his name, are saying that banks buy IUL. That is a complete and utter lie. And that poor young man will lose his licenses once somebody calls him out on that. Banks absolutely, positively do not buy IULs. Banks only buy whole life insurance, period. Look it up. Go into Google BOLI on any government website, and you can be the determining factor. Whole life. Why? Well, here's the reason why banks buy whole life. Banks have what's called they have different tiers of money. Okay. The top tier is called tier 1. It goes by a couple different names, but we'll just call it tier 1. Tier 1 assets of a bank are their most prized possession. Not only are they prized, the government mandates that the bank has a certain amount of money, usually about a little over 10% of all the deposits they have has to be in tier 1 assets. But the government puts some unique restrictions on tier 1 assets. They have to be in guaranteed accounts. So, what does the bank look for? Guaranteed accounts. And where do they land? One of two places. We'll leave real estate out for now, but one of two places where they land. U.S. Treasury bonds, because they are guaranteed by the full faith and credit of the U.S. government. So tier 1 capital can go to U.S. Treasury bonds. You've all heard me teach about Treasury bonds, and this weekend I'm going to talk more about Treasury bonds and why it's a great time to buy them. But banks love Treasury bonds for their tier 1 capital. Banks love another asset way more than Treasury bonds, and that is whole life insurance. Because whole life insurance has one of the best guarantees in the industry and in the world, and that is a giant insurance company that has tons of cash sitting there in reserves called their general surplus accounts that guarantee the banks deposit money into those. So all of the money that they put into the whole life has a stamp that says guaranteed by XYZ insurance company. So why did these five banks put 75 billion there? Because it satisfies the guaranteed need that insurance company has. So let me just go one more. Okay, and actually let me come back to this. So if we know that the banks put money into whole life, and all we're talking about is you being your own bank, we already talked about BYOB. Okay, you make money, W-2, 1099, maybe some other ways. You save money. Okay, many of you already said you have a 401k, which means you're saving. And your 401ks, we covered this yesterday. I didn't hit it today. Back them down to the match. If your match is 3%, put in 3%. The difference goes where I'm going to show you next. If you're putting in 6% because the bank matches 50 cents on the dollar up to 6%, 50 cents on every dollar up to 6%, then put in 6. Okay, whatever your match is. The rest, we're going to change where the saving goes first, okay? And we're going to put that money into your own bank, the same place banks, like I just demonstrated, put their money, and that is a specially designed and engineered SDE whole life policy. And this is going to serve as your bank. But you see, with your checking account and your savings account, there's a reason you put money in those, and that's because you need liquidity. Great. We're going to design your whole life totally different than any whole life you've ever seen, totally different than any whole life that Dave Ramsey or Susie Orman or any of the other buy term invested difference people are talking about. We're going to design it so it has liquidity because we want the ability to immediately use that money within the first 30 days. Can all of you repeat that? I want liquidity. Just put it right in the chat. Liquidity. Okay. You want liquidity of your money. Is immediately in the first 30 days enough liquidity for you? Great. Okay. So we're going to put our savings in there. Now, let me just show you, because a lot of people like just seeing numbers. So what I'm going to do is I'm going to show you something here. This is a real client of ours. And I just want to real quickly dissect some of these numbers. His name was Kevin. So Come on, everybody, say hi to Kevin. It's kind of like AA. Say hi, Kevin. All right, so this is Kevin. That is actually his real name. All right, Kevin had $50,000 sitting in somebody else's bank. He heard one of these presentations. He came to a 3-day and he's like, oh, I don't want 50 grand sitting in their bank. They're only giving me 0.002%. I want more. Great. Well, Kevin found himself a mutually owned insurance company through this whole life that would pay him with dividends 5.2%. So Kevin's like, all right, I want to put 50 grand into that at 5.2. Great. So here's the 50,000 Kevin put in. It's a dump in. He took the money from their bank. He put it in his bank. Why? 5.2 reasons why. Okay. Then he decided he wanted to save money every month at the rate that he was saving. Now, I know this is a little weird. He was saving $500 a month, roughly. When we designed the policy, it just came out to be this weird number of $491.25 because of the dump in. Doesn't matter. So he's putting $491.25 a month into his bank, his policy. That's $5,850 or $5,895. And then in his first year, Kevin had $51,000 available. Now, real quick, I'm going to stop share. Now, let's just recap that. Okay. Kevin put $55,895 into his policy. Okay. $55,895. I want you to remember that. Kevin had the ability in the first year to take $51,000 out. Okay. That works out to be about a 92% loan rate that he could take. Now, not everybody's policy is going to be 92%. Some might be 70, some might be 85. We're going to design the policy around your needs. Kevin was a real estate investor, so he wanted access to more money early, which means he gives up a little bit of money later. Are we clear? Take higher percentages early, you're going to give up a little bit later. That's the only difference. All right. But he wanted the 92%. So what Kevin did is Kevin, and I don't know what he did, but let's just pretend Kevin went on to Private Money Club and he found somebody. Hey, actually, let's just do this. Does anyone on here need 50 grand right now? Does anyone need to borrow 50 grand? Anyone? Just put 50 grand. Do you need, anyone on here need 50 grand? All right. Whoa. All right, Tanya, we're just going to, I didn't think there'd be that many. All right. So this is why Private Money Club works so well, folks. Tanya needs 50 grand. Now, Tanya, are you willing to pay 12% to Kevin for 50 grand? Can I get, holy crap, should have raised it. Tanya, are you willing to pay, just put a yes in the chat. Are you willing to pay Kevin 12%? Or Tanya, I'm sorry, Tanya. So now that we got the pronunciation right, Tanya, are you willing to pay 12% to Kevin for 50 grand right now? Okay, so Tanya is willing to pay him 12%. Okay, so she's willing to give Kevin 12%. And what he's going to do is Kevin is going to take a loan from his policy. Now, how long does it take for him to get that loan? Well, he can do it immediately in the first 30 days. So Kevin takes the loan and he puts it and he gives it to Tanya after some things. He does a note and they come to agreement. That note says 12%. Then he gets a mortgage from Tanya so that no matter what, this property is securing his money. What is 12% of 50,000, Stephen? What's that work out to be? I'm just doing this on the fly, folks. This isn't like pre-done stuff. We're just kind of rolling with this. So bear with me when I got to pause and do some math. That's $500
a month.
So Tanya's got her 50 grand. She does something, whatever with it. She's going to pay him 12%. Kevin is then going to take that 12% and he's going to then circle back and put the money back into his policy as a loan repayment. Because if he takes 50 grand out, here's what I want to be clear about. And I'm going to go back to my screen. If he takes 50 grand out of his policy, can anyone tell me whose money he's taking? Is he using his money? Okay, is Kevin, when he takes a loan for 50 grand, is he using his 50 grand? Or is the insurance company advancing him? That's right. See, the insurance company, when he started this policy, and I don't have it on here, but they promised him a death benefit. And I think his was like 500,000 bucks. Okay, so the insurance company's on the hook if, sorry about that, scratch. The insurance company's on the hook if Kevin dies for $500,000. That's what the insurance policy states. The insurance company allows Kevin to take a loan against his death benefit. So now Kevin takes 50 grand against his death benefit. So his death benefit, technically, if he died the next day, is only 450 because he lent the 50 grand out at 12%. Okay. So that's where the money came. So because it wasn't his money, how much money is still in Kevin's account? Well, the 50 grand is still in his account. And how much did I say the insurance company was paying him on that? 5.2. Okay. So if it's 5.2% that he's earning on the 50 grand that he just gave to Tanya, he's making uninterrupted compound interest because all that money pretty much got moved out, all but $1,154, right? That's his loan value he had. So he used 50 of that 51,000. Now, the insurance company does not give Kevin that money for free. They're a profit company, so they're going to charge an interest rate. As of right now, this insurance company, I think, am I correct? Is it 5%, Stephen, or is it 4?
It's at 5.
5. Okay. So the insurance companies we work with are between 4 and 5%. I just had to remember I have him with Lafayette. So they're 5. Okay. So 5%. Now in the middle, everything we've talked about, the magic word, the word of the day was spread, right? All right. So if we just did gross, they're paying him 5.2% with dividend because he's going to receive interest and dividend. I get rid of some of these numbers on here. 5.2, and it's going to cost him 5%. What's his spread? 0.2. Nothing to write home to about, but more than some of you are getting in your savings and checking account. Okay. So year one is he's making that. So he's getting his 12%, which is the real, and he's making a gross spread of 0.2%. Okay. So now let's go to the next year, because remember, when he took the money out, he didn't have to go into his money. So his money was able to sit there and compound. So let's look at the impact of that. The second year, Kevin puts another $58.95 in over the course of the year. But because he had all of his money in the account earning compound interest at a rate of 5.2, the second year, his money, $58.95, grows to $71.41. That's $1,246 he made on that year's deposit. A lot of people want to say, well, wait a second, he put $55,895 in the first year plus $58.95 in. They're doing the cumulative return. I want you to please remember that the first year, the money he put in, he took out 92% of that. So that money's already out working for him. So the return we really care about is called cash on cash. Real estate investors know this. Financial advisors struggle with this. Cash on cash. Okay, that means we only want to know the return we're getting on the new monies that we put in the second year. So $58.95 is $71.41, $12.46. If we run the math, if we do $12.46, which is his true net gain, net after cost of insurance, net after policy service fees. Insurance companies are profit companies. Never forget that. Net $12.46. Divide that into his deposit, $58.95. That's the number you're going to get, 21.14. And every single time we look, I do in 5-year, well, 4. Okay, year 5, year 10, year 15. Look at these returns: cash on cash, cash on cash, cash on cash, cash on cash. But remember, it's going to cost 5% to use the money. So 21 minus 5. 26 minus 5. Does anyone even give a shit that the insurance company is charging you 5 when you make 21? Does anyone care that the insurance company is taking 5 of the 54% you made in the 10th year? Does anyone care that the insurance company is taking 5 of the 115% cash on cash you earned in year 15? I didn't think so. I was just asking for a friend, folks, just asking for a friend here. You see, the spread might only be 0.2 year one, but every year the spread goes up. And every year, Kevin just has more money to keep deploying to Tanya or whoever else needed it. And he just keeps playing this game. And every single time he makes that, or he takes that $500, and instead of putting it into what we do today, somebody else's bank where they make it work for them, this $500 comes back over here, replenishes his account at a tune of $500 a month. So the next year he's got an extra on top of that $7,000, whatever that was, $7,100 that he has in year 2. He's also now got another $6,000, which is the $500 a month Tanya paid him. So now he's got more money to deploy next year doing the same thing, and over we go. So this is what we teach. But you see, we did it backwards today. We started with non-traditional assets like your house, then your 401k. We could go all day long. And then we landed at the ultimate where banks put their money, which is a specially designed and engineered whole life, which we can help you set up. And we're going to go deeper into this weekend, but I just wanted to touch the surface. Stephen, do you want to show yours now?
Yeah, and then we're going to have to do a couple questions and wrap because we're going a little long here.
Oh my gosh, we're over. I told you what happens when I put this damn pen in my hand.
Yeah, I'll show you. I'll show you one more here. So this is just another illustration. So, all right. So this is another one. This was a real estate investor put 150,000 in the first year and then decided to put 50,000 in a year after that. So you can see all that. And then you can see as soon as they put the 150,000 in the first year, they have 132,000 to borrow back out. So that way the whole 150 is still in their compounding. So they can take that money and then go, do whatever they want to do with it, lend it, etc. But look how this thing goes out over time. Because remember, you have to put your money somewhere. So your choices are put it in someone else's bank, make them rich, or put it into your own bank and make yourself rich. And watch how that happens. Because as you put money into this thing, the money's just going to compound and grow stronger and stronger and stronger every single year for the rest of your life. So now let's look at what that looks like.
This is a really good.
What this looks like. All right. So let's just take the 8th year of this thing, for example. Okay. You've had it for a few years. You've been doing some active real estate. Now you want to pivot over and do some passive real estate, some mailbox money. You want to generate mailbox income coming in, right? Without having to do the work. So here's what happens. In the 8th year of this thing, their bank grew by $66,722. That's the increase in the cash value. To get that, they had to inject $48,593 into it. So if we do the math, that's $18,000 growth or a 37% cash on cash return that year of the policy, internally tax-free. So then what they did is they took that money out of there and they did a private money loan through Private Money Club at 12%, just like Chris was talking about. So if we add up the entire what we did, 12% on the private money loan, 30% internal growth of our banking policy, 5% paid to the insurance company to use that money, for a grand total of 44% returns that year using that strategy. Now, if we compare that to if this entire time I was putting $50,000 into somebody else's bank and then took that same money, did the same private money loan, that's great. I would get 12% for the private money loan, but that's it. So the only difference is I put the money in my bank instead of somebody else's bank. And that then allowed me to get a 44% return on my cash that year instead of a 12% return. So I'll ask you, which one would you rather receive without doing anything different? You're not working harder. You're not taking on any more risk to get 44 as opposed to 12. You're just changing one thing. That's where your money goes first. And that's the power of being your own bank.
That's such a great example. And I love how that one really dissects the returns. So again, just final call out. I just put the link in there again. Join us this weekend. Get your deck, your hat, or your shirt, and use the code virtual discount. This is going to be the last opportunity you guys are going to have to get these discounts. After today, we will pull this link, so you will no longer get it for $197, and you definitely aren't going to get the skateboard or the other things. So here, real quick, Stephen, let's go through some of the questions because you've been looking at them as we go. So let's try to get through as many as we can.
Yeah, this is just back to the Airbnb thing. I don't think exactly. Do you have an opinion about how long we will need to float the reductions in long-term or Airbnb rental rates?
That's a great question. What would you say, Stephen? What do you think would be safe? 12 months, 6 months, 12 months? If I were lending on it, I'd want to see 12 months. I'd want to at least see that you have enough reserves to carry, the property for 12 months, or at least the wherewithal to then rent it out and support it with a rent. Yeah, I would say 6 to 12 months minimum.
Yeah, that makes sense. Do you prefer a HELOC or a home equity loan agreement?
It depends. It depends on the need and the use. They both have their place.
And we'll talk a lot about that actually on Friday, and we're going to bring on the HELO man himself, and we're going to get into that on Friday. So join us Friday and we'll get in more depth on that one. For the HELOC, what if you had bad credit, inconsistent income because you're self-employed?
Oh, that's a great one. That's exactly what we were talking about. We have Matthew coming on to show you how you can do a home equity loan agreement, and it won't matter at all what your credit score is. You can basically get the equity out of your house, and you won't even have a monthly payment, and you won't have debt on the books. What you're going to do is you're just going to share future appreciation in whatever time frame you want. It could be 10 years, 30 years, whenever you decide you want to sell your house. You're going to give up some of the future appreciation of the house and only upward appreciation at that time when you sell, in return for having use of the equity in your house now. So we've got a speaker coming on to talk about that.
All right. Do you know if a bank will lend on a second HELOC, a home equity loan, using a second lien subject to sufficient equity available in the property?
Yeah.
Yeah, well, that's pretty much what a HELOC is.
Yeah, that's exactly what they do. 100%.
A HELOC bank at 90. I need a HELOC bank at 90.
Okay, we'll have that this weekend. So there's one bank we know of, and I know there's a couple more that does 90%.
What if my only debt is our mortgage? We have no credit card or auto loan debt, but I want to find a way to pay down the mortgage to free up that money for investments. I already have mutual life insurance policies through Penn Mutual that I started in the spring for my husband and I. Did take a loan against one of our policies to pay off a car loan, and I'm repaying that now.
So if your only debt's your mortgage, we'd really have to look deep into that mortgage and figure out like what is the rate that you're locked in at, how much debt is on that, what stage of the mortgage are you in? Are you in the first 7 years? Are you in the 15th year? All these different factors really play into it. We could definitely go deeper into that, but that's a tricky one, Charlotte, because there's so many moving parts with a mortgage and in the velocity of how the interest is paid on them. If it's an earlier mortgage, like in the early stages, it makes a lot of sense to pay them off. But if it's in a later stage, you're like, I've only got 10 years left. Probably if it's a low interest rate mortgage, not going to make sense to pay that one off because we can make more money out there, just like I showed in other asset classes without worrying about paying a low interest rate mortgage off.
Yeah, absolutely. My wife and I own a couple businesses based on education. Are we able to use this type of business for the private money club? So Dave, if you're looking to borrow money from the businesses right now, everything in private money club is real estate related. So real estate backed assets and loans. But if you're using money from your businesses to lend, I mean, I wouldn't see a problem with that if you're looking to just grow your money.
Yeah, Dave, happy to jump on a call with you about that.
Lisa, if I've already signed up for an insurance policy with your team, will I still benefit in attending this weekend?
I've already signed up for oh God, yeah.
Yeah. So Lisa, this is actually why this 3-day training actually exists, because we have so many different clients that start these policies and then they pay off their debts, or, they get the car paid for and they're like, okay, well, I have all this money sitting in the policy. Now, what do I do with it? And so that's, a big emphasis behind why we started Private Money Club, and where our focus for these 3-day trainings is to show you how to use the money in your policy to keep that money moving, to make more money and grow and build wealth for you. So this is the place to be, this 3-day, especially if you already have a policy. Chris, do you have an affiliate program for financial advisors?
It depends on what we have. Affiliate programs for sure. We have affiliate programs for Private Money Club, and we're rebuilding it. We're building a really robust one for Private Money Club. So for that we do, and for our other programs, the only thing we don't have an affiliate program with is for the banking systems, so the BYOB money multiplier stuff. But if you're an advisor, chances are you're life licensed, then we could definitely, pay you an affiliate with a split in commissions. So we definitely could do it that way if you refer business over, but that would only be if you're life licensed in the state that you're sending referrals from.
I think the insurance company will only loan to you the cash value available in the policy. In the first years, there will be a large surrender charge deducted, so your available cash is much lower, minus the surrender charge.
No, Sally, you're thinking about IULs. See, this is where the mindset, like I know we just touched the banking stuff really quickly, but surrender charges are found in universal life contracts, okay? IULs, VULs, or just traditional ULs. There's a surrender charge, can be anywhere from 6 years to, I've seen them as long as 11 years. Whole life does not have a surrender charge. It's not going to have 100% liquidity of all the money you put in the first year, maybe sometimes second or third year. But like I just showed you, and like what Stephen showed you, it was 90 to 92% on those two contracts. So Sally, you haven't been around the campfire long enough to really understand how they work. You're confusing an IUL and the negatives that come along with IULs with a whole life, and that is not the case with whole life in any way. Matter of fact, there's probably 100 people on here that have policies, and all of them would tell you that that isn't the case at all.
When you take out a loan for the policy, don't you have to pay a fee every year the loan is out?
It's not a fee. It's when you take a loan from the policy, you're going to pay interest. If you remember in this example I did, the interest rate for the loan is usually, with all the companies, right, 4 to 5%. So this is what's going right now. So you're going to make pay 4 to 5% simple interest, okay, and then they're going to pay you. The lowest we have right now is 5.2, which is the one I showed you with Kevin, to 6%. So you're making 5.2 to 6 with dividend. They're charging you 4 to 5%. This is compounding uninterrupted. This is simple interest. Good question.
Are there HELOCs that are asset based only? We're in the building phases of building a few businesses and money is only going out, no income right now. The home will be rented out again soon. The income from the asset will be the only provable income when we get ready to apply for a HELOC.
Most of them don't. You could find banks, if it's a large enough loan, or certain institutions that will lend on asset based. The ones we're talking about, to keep it simple, we're just real estate based, because that's the easiest ones to get. So
I would say potentially
yes.
Private Money Club, potentially, Chris.
Yeah,
I mean,
in the future, Private Money Club for sure.
Well, even right now for the rental property. I mean,
I missed that rental property part.
So potentially Private Money Club. Absolutely. All right,
Yeah,
cool.
Sal, you're right. Traditional non-banking policy. So if you buy yourself a regular whole life insurance policy, you're not going to have any cash value in the first year, second year, and a lot of times third year. But the policies we design, all of them have access to your cash value, the available cash value, immediately in the first 30 days. That's a good point. All right. So folks, I'm going to put the link up one more time. Get yourself a ticket to this weekend. If you can't make it, you get all the recordings edited down, plus the goodies that we're giving you for doing that. So do not delay on that. So Ben, we've got Devin Burr, who's in Arizona. You could sit down with him. So
I'll connect him.
Yeah, connect him with that, and rock and roll is right, Tyler. Rock and roll. So folks, I know we went over today. I hope you guys enjoyed this information. I get crazy when I get that stupid pen in my hand. I went a little overboard. So if that's what you got in an hour and, well, a little over an hour and a half, what are you going to get in 3 days of us teaching you? It's going to be tremendous, life-changing information. So we will see you this weekend starting Friday. Get your tickets, and we'll see you then. Thanks, everybody.